I'm Shil Shah, Group Head of Tax Planning at Skybound Wealth Management. I lead our cross-border tax strategy for internationally mobile executives, founders and families, helping them navigate the structural decisions that protect wealth across jurisdictions. In this session, we're going to discuss something that often feels like a return to familiarity, but in reality represents one of the most financially sensitive transitions an expat can make. Moving back to the UK, because returning home does not simply mean resuming life where you left off. It often triggers a financial reset, and when that reset is not planned properly, exposure can arise quietly, sometimes years after the move. In this session, I'll walk you through how UK tax residency is re-triggered, what happens to overseas investments on return, the treatment of pensions and property, and how capital gains exposure can change, and finally, why inheritance tax planning should be revisited before you come back. If you are planning to return to the UK or considering it in the next few years, this will give you a structured framework for what needs reviewing before relocation. Let's begin with the first and most overlooked issue. Residency is re-triggered automatically. When you return to the UK, residency does not require negotiation. It is often re-triggered quickly, sometimes from day one, depending on days, home, and work patterns. The statutory residence test applies in reverse. If you spend sufficient days in the UK, or establish a home, or begin working in the UK, residency is often re-established. There is no transitional buffer period. Now that may sound obvious, but here is what is not obvious. The moment UK residency is re-triggered, your worldwide income and gains come back into the UK scope, which means assets that have been building offshore for years may now sit inside the UK tax system again, and that changes the behavior immediately. The investment reset most expats miss. Let's look at a practical scenario here. You've lived in Dubai for 6 years, you have an offshore investment bond, a general investment account, perhaps shares accumulated while non-resident. While abroad, growth may have been tax deferred or taxed differently. Now you return to the UK. From the date UK residency resumes, UK income tax rules apply. UK capital gains tax rules apply. Reporting obligations resume. Growth inside certain wrappers may remain deferred. Growth in others becomes immediately reportable. What often happens is this. The investment structure that worked efficiently abroad is simply carried forward unchanged. But the UK tax environment is different, and failing to realign structure before return can create unnecessary ongoing exposure. Capital gains, the timing question. Now let's talk about capital gains. This is one of the most sensitive areas. Imagine you hold a portfolio of shares, an investment property abroad, or even UK property purchased while overseas. You plan to return to the UK in April. You are considering selling assets. The timing of disposal relative to your return date can materially change the tax treatment. If assets are sold while genuinely non-resident, UK CGT may be reduced or not apply even in some cases, but it depends on the asset type and your wider timeline. If sold after UK residency resumes, gains may fall within UK scope. Now add complexity. If you sell before returning, but intend to move back within 5 tax years, temporary non-residence rules may still be relevant, which means timing is not simply about the sale date, it is about the broader timeline. This is why pre-return reviews are critical. Once residency resumes, options really do narrow significantly. Overseas pensions and income streams. Another area that often requires review is pensions. During your time abroad, you may have built overseas pension entitlements, continued UK pension agreements, or structured retirement assets in international wrappers. And so on return to the UK, the taxation of pension income may change. Double tax treaty interactions may fall away. Reporting obligations resume fully. What was tax neutral abroad may become taxable in the UK. Foreign currency income may now create additional complexity. This is particularly important for individuals returning later in life when income withdrawals begin. That transition should be reviewed before the arrival and not after. Property and structural exposure. Now let's consider property. Many expats retain UK property while abroad. Others purchase overseas property. And on return, UK rental income reporting resumes in full. Overseas property income becomes part of UK self-assessment. Capital gains exposure changes, but there is of course another layer: inheritance tax. Inheritance tax implications on return. Since the domicile reforms, UK inheritance tax exposure is increasingly now residence-based. Returning to the UK can restart the clock on IHT exposure. Extended UK residents may re-establish exposure to worldwide assets under UK inheritance tax rules. Trusts established while non-resident may now need review. Gifting strategies should be reconsidered. For high net worth individuals, this is often the most significant issue, and it is rarely addressed before the move back, the financial reset moment. When expats return to the UK, there is often an emotional assumption, I'm just going home. But financially, you are re-entering one of the most comprehensive tax systems in the world. The return year is not just logistical, it is structural. It is a reset point. This is the moment to review investment wrappers, consider crystallizing gains before return, revisit pension positioning, reassess estate planning, align structures to UK rules again. Without review, inertia becomes exposure. Practical framework before return. If you are planning to move back to the UK, I would suggest reviewing 5 areas before you relocate. The exact date residency will resume, the timing of planned asset disposals, the structure of offshore investments, pension income treatment, and inheritance tax exposure under the new residence-based system. Clarity before arrival creates optionality. Clarity after arrival limits it. Returning to the UK is often framed as a personal decision, but financially, it is one of the most significant transition points in an expat's journey. Residency, gains, income, and inheritance tax exposure can all shift simultaneously. If you found this session helpful, there will be further sessions in this series covering capital gains and UK property, inheritance tax reform in more depth, cross-border planning in zero tax jurisdictions, and liquidity events while abroad. You can subscribe to stay informed as new sessions are released. You can follow Skybound Wealth Management for ongoing cross-border insights. And if you are planning a return or reviewing your position post-arrival, feel free to reach out. Repatriation should not be reactive, it should be structured. Thank you for watching.